you might have noticed that markets reward different assets at different times. That's exactly why we stay diversified. After all, like a football team with one star player, they can produce some great victories from time to time. But I think we all appreciate that if you want to go on and win trophies, it's the squad as a whole that matters. Now, I'll come back to that point later. But first of all, what's the world been like this quarter? Well, the answer is quite mixed. Inflation is moderating, but it's not yet back to target. And so here in the UK, the Bank of England held rates at 4%, while in the US, the Federal Reserve resumed its easing cycle. Bond yields were volatile, with the long end rising early in the quarter and then cooling, while equity markets stayed near their highs, although leadership remains narrow with a few large US companies doing most of the lifting. You might have noticed that the dollar moved up slightly in the quarter, but even so, sterling is still considerably stronger year to date. And as a reminder, we do hedge most of our foreign currency exposure back to sterling, so the fund's income remains protected. What did that mean for results? Well, the fund was up around 1% in the quarter, which takes it to just a little under 6% for 2025 year to date. Bonds helped both emerging market debt and corporate credit as US duration rallied and spreads tightened in most regions. Equities were positive in absolute terms, although our portfolio lagged a very concentrated global index. Now, that can be frustrating in the short run. But we find that when markets are narrowed, diversified income portfolios often do trail on the way up. But they tend to hold up better when conditions get tougher, which is exactly what we saw in April around Liberation Day. And why does that resilience matter? Because it protects the capital that supports future income growth. In terms of positioning, you'll have noticed a few new names in the portfolio. One of those is Primary Health Properties, which triumphed in a hotly competed takeover battle for a business called Assura, a healthcare property specialist that we've owned in the fund for a number of years. We're actually pleased with the outcome here for a couple of reasons. First, because we didn't think that the alternative offer from private equity fully reflected the long-term value of Assura. But secondly, a private equity takeout would have meant losing ownership of a fairly unique asset that we think is actually a really great fit for the monthly income fund, given its attractive, largely government-backed, and growing dividend. So rather than lose this investment altogether, not only do we get to enjoy around about a 30% year-to-date total return on what was the largest real estate position in the fund, but we also get to stay invested for the long term in a larger, more cost-efficient vehicle. In the equity portfolio, we added a new position in MSCI. We like its global leadership in the financial indices and risk analytics spaces, which comes together with a sticky client base and demonstrable pricing power. In the high yield portfolio, we added a position in Boots. Now, the coupon on this bond is more than 7% and is supported by a resilient franchise and strong cash coverage. Finally, in emerging market debt, we introduced new positions in Guatemala and Romania, where we see solid fundamentals and potential for spreads to compress. More broadly, our base case is that economic growth remains steady, inflation continues to ease, and monetary policy normalizes gradually, which in practice means that we remain focused on assets that generate dependable cash flows. Asset allocation remains deliberately balanced, with equities, bonds, and real assets, by which we mean property and infrastructure, all making up around a third of the portfolio, with another 2% in cash. Compared to last quarter, we did increase risk a little bit, adding around 1% to equities and around 0.5% to high-yield bonds, with both of those trades funded from cash. Now, stepping back, I think there's 3 simple takeaways for this quarter. First, diversification is doing its job. So while the market has bid up a very narrow cohort of companies that are spending significant amounts of capital on artificial intelligence, we have limited visibility on the long-term return that those investments will generate. And so while some of our investments will benefit from AI adoption, both directly and indirectly, we prefer to keep this blended alongside dependable earners that can keep income flowing in all environments. Second, the pipeline for catalysts is improving. So as artificial intelligence spend normalizes and interest rates drift lower, we expect participation to broaden, which should be helpful for dividend-growing companies. And third, the bond allocation continues to earn its keep. Carry remains attractive, and we stand ready to adjust risk should default trends change. So the outlook on the whole is cautious, but positive. We still expect to grow 2025 distributions by around 6%. Now that view is resting on steady cash flows and a portfolio with multiple engines for performance that doesn't require perfect conditions to deliver. So if inflation surprises, if geopolitical risks intensify, or even if market leadership rotates, there's room in the mix here for different engines to kick in and contribute. And that is the value of balance. So if you remember one message, make it this. Dependable income comes from many engines, not one. And that is how we're running the portfolio today.